Welcome to Thoughts on the Market. I'm Mike Wilson, Morgan Stanley CIO and Chief U.S. Equity Strategist. Today on the podcast, I'll be discussing the recent equity market correction and what to look for next. It's Monday, March 17th at 11:30 a.m. in New York. So let's get after it. Major U.S. equity indices are as oversold as they've been since 2022. Sentiment and positioning gauges are bearish, and seasonals improve in the second half of March for earnings revisions and price. Furthermore, recent dollar weakness should provide a tailwind to first quarter earnings season and second quarter guidance, particularly relative to the fourth quarter results. And the decline in rates should benefit economic surprises. In short, I stand by our view that 5,500 on the S&P 500 should provide support for a tradable rally led by lower quality, higher beta stocks that have sold off the most, and it looks like it may have started on Friday. The more important question is whether such a rally is likely to extend into something more durable and mark the end of the volatility we've seen year to date. The short answer is probably not. First, from a technical standpoint, there has been significant damage to the major indices, more than what we witnessed in other recent 10% corrections like last summer. More specifically, the S&P 500, NASDAQ 100, Russell 1000 growth and value indices have all traded straight through their respective 200-day moving averages, making these levels now resistance rather than support. Meanwhile, many stocks are closer to a 20% correction, with the lower quality Russell 2000 falling below its 200-week moving average for the first time since the 2022 bear market. At a minimum, this kind of technical damage will take time to repair, even if we don't get additional price degradation at the index level. In order to forecast a larger, sustainable recovery, it's important to acknowledge what's really been driving this correction. From my conversations with institutional investors, there appears to be a lot of focus on the tariff announcements and other rapid-fire policy announcements from the new administration. While these factors are weighing on sentiment and confidence, other factors started this correction in December. In our year-ahead outlook, we forecasted a tougher first half of the year for several reasons. First, stocks were extended on a valuation basis and relative to the key macro and fundamental drivers like earnings revisions, which peaked in early December. Second, the Fed went on hold in mid-December after aggressively cutting rates by 100 basis points over the prior 3 months. Third, we expected AI CapEx growth to decelerate this year, and investors now have the DeepSeek development to consider. Add in immigration enforcement, the Department of Government Efficiency exceeding expectations, and tariffs, and it's no surprise that growth expectations are hitting equities in the form of lower multiples. As noted, we highlighted these growth headwinds in December and have been citing a first-half range for the S&P 500 of 5,500 to 6,100 with a preference for large-cap quality. Finally, President Trump has recently indicated that he is not focused on the stock market in the near term as a barometer of his policies and agenda. Perhaps more than anything else, this is what led to the most recent technical breakdown in the S&P 500. In my view, it will take more than just an oversold market to get more than a tradable rally. Earnings revisions are the most important variable, and while we could see some seasonal strength or stabilization in revisions, we believe it will take a few quarters for this factor to resume a positive uptrend. As noted in our outlook, the growth-positive policy changes like tax cuts, deregulation, less crowding out, and lower yields could arrive later in the second half of the year, but we think that's too far away for the market to contemplate for now. Finally, while the Trump put apparently doesn't exist, the Fed put is alive and well in our view. However, that will likely require conditions to get worse either on growth, especially labor, or in the credit and funding markets, neither of which would be equity positive initially. Bottom line, a short-term rally from our targeted 5,500 level is looking more likely after Friday's price action. It's also being led by lower quality stocks. This helps support my secondary view that the current rally is unlikely to lead to new highs until the numerous growth headwinds are reversed or monetary policy is loosened once again. The transition from a government-heavy economy to one that is more privately driven should ultimately be better for many stocks, but the path is going to take time and it's unlikely to be smooth. Thanks for listening. If you enjoy the podcast, leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.